Thank you for joining me on my market report. My name is Mike, and the market report goes over mortgage rates. We kind of like to go into what's pushing mortgage rates on a daily basis, what's impacting them, and how if they're moving sideways or moving up or down, and kind of help you kind of gauge if you're in the market to refinance or purchase, to give you an idea where rates are moving. And they do move on a daily basis, like basically stock market, as these are packaged and sold as mortgage-backed securities on Wall Street. Uh, that's why we'll see fluctuations in mortgage rates. Now, a little bit about what we also do is we don't get into rate quotes. We do, there's just too many variables going there. However, if you want a personal rate quote, I'd be more than happy to do so. A little bit about myself is I am a loan officer. I do work with a national lender. I'm here to answer any questions you might have, whether regards about the process, about mortgage rates or mortgage programs that are available out there. I'm here as a source for you folks if you guys like to, if you need information, or if you guys are looking to refinance and or purchase and need a pre-approval and need a person to help you with those. We're here for you as well. Please feel free to reach out. Just contact us through the social media site you um, found us on and send us a direct message or message, and we will definitely be reaching out to you. Um, so without a little further ado, why don't we jump right into we'll start with the economic report. And basically big thing today is inflation. The CPI report came out, and both the headline number, the CPI, Consumer Price Index, and the core CPI. CPI is basically uh, the food and energy are removed from it. So those are two variables that you have no control over, so they kind of remove those to get more what you call your core. So both those went up 0.9% for the month of June. Now the annual year over year for the headline number did go up to 5.4% from the 5%. And the core, when you strip out food and energy, went from 3.8% to 4.5%. This is a pretty hot number. This is actually the hottest number, biggest spike we've seen in about 30 years since September 1991. And obviously that's a pretty big thing we do. However, we'll take a look here, see how markets reacting to it. Stocks are a bit mixed. Dow is only one negative territory. We had a big jolt in both the stock and you'll see in the bond market due to the bit high number, and then they kind of settled in a little bit and subsided. And basically, keeping the thought in mind that the Fed had said it's transitory, so they are kind of shaking off now as transitory, but that initial shock did send a wave through the markets initially. We're also getting corporate earnings reports for our second quarter. We're getting the banks coming in, people like Chase and Goldman Sachs and people of that. So investors will probably get some type of distraction looking at corporate reports, earnings reports as we go on from into the month. Let's see how this is playing out with the bond market, see what mortgage rates are doing today. We had a bond rollover, which means basically we do a reset in pricing. So we basically start the next set of mortgage applications for next month. So what happens is loans starting today for the next 30 days will go on to August numbers here. And that's why we had these what they call 30-day locks. And there's even though it looks lower on the chart here, it doesn't mean the pricing has changed at all. But so for today, right now we're up 2 basis points. Basically, what that means is that we're in the same range. So rates are remain unchanged. Now, earlier lenders may have priced in worse when they had, as you can see here, we had that big spike after that inflation data came out. It dropped dramatically, but has pulled back, and now we're in plus 2 basis points right now. So, with the, let's take a look at the treasuries, and Treasury did the same thing. As you see, we spiked all the way up to like 1.39, but subsided back downwards towards just under 1.36 right now as a result as well. So again, mortgage rates right now kind of shaking out the dust from the inflation. As you can see, normally if we have high inflation, the enemy of bonds is inflation. So that would be a normal reaction from. But because the Fed has indicated that this is all transitory, things will subside, get back to normal. Uh, Investors are kind of shaking this off and kind of figuring, okay, this will be just a temporary situation. This isn't permanent. So the Fed knows what they're doing. They're going to just kind of go with it for right now. So um, in the meantime, If you guys got any questions about anything we can help assist you with, please feel free to reach out. If you like these videos, please again help out the channel and smash that like button. We certainly appreciate that. Appreciate you guys viewing our videos. You guys have a great rest of your day. Thanks so much for watching. I look forward to seeing you in tomorrow's video. Bye bye.